Good day everybody, I trust that you are well. The purpose of this video is to give you my comments on Investec's marketing material pertaining to their latest product offering, which is 3 autocalls. You will note that 2 of the autocalls are linked to the Euro Stoxx 50, whilst the third one is linked to the S&P 500. You'll further note that there are 2 options when it comes to the autocalls linked to the Euro Stoxx 50. The one pays in rands and the other one pays in dollars. Both of these autocalls are linked to Standard Chartered bank credit risk, and the S&P 500 autocall is linked to Royal Bank of Scotland credit risk. We'll get into that a little bit later. So I just want to run you through Investec's marketing material. Okay, so I'm going to focus on options 1 and 2 in this video, as from a yield perspective I think it offers better value than the S&P 500 autocall. You will note that both these pay in dollars, but the autocall linked to the Euro Stoxx pays 11.25% per annum in dollars versus a 7.75% per annum in US dollars linked to the S&P 500. What's important to note here is that the credit reference entity on both these options is Standard Chartered Bank. We'll go into a little bit more detail later as to why that is important, but long story short, if you invest in this autocall and the Euro Stoxx 50 in 1 year's time is at the current strike price or at a higher level, the investment automatically comes to an end and it pays you a 20% return. If at the end of year 1 the Euro Stoxx 50 is below the current strike price, it will roll for a further year, and if at the end of year 2 it is higher than the current strike, then 40% will be paid to you per annum. And so it goes on. So if it's in year 3, if it's not higher than the current level, it will roll for another year, up until year 5, which is the maximum duration of the investment, whereby it will pay you up to 100% cumulative, which equates to the 20% per annum. If we have a look at the dollar option, it pays 11.25% per annum. But just note that here your rands gets converted to dollars at the current exchange rate, and here you are taking some currency risk. So if the rand appreciates, whatever percentage it appreciates by will be deducted from your return, and if it depreciates, whatever percentage it depreciates by will be added to your return. So we'll have a look at an example a little bit later. As I mentioned, the term to maturity is 5 years, provided that it doesn't call earlier than the annual automatic call date. You have 100% capital protection, provided that the index does not end below 60% of the initial index level. And that is with regards to the 2 autocalls linked to the Euro Stoxx 50. I'm not going to go into details on the one of the S&P 500 in this video. So automatic call dates is from year 1 onwards, year 1, year 2, year 3, year 4, and year 5, depending on whether the market is up in a year's time from now. And all fees have been built into the product. In other words, these returns are net of all fees. I'll also show you that a little bit example later. So why are autocalls popular? It gives you a predefined return. The return is very attractive in the current environment. 20% per annum is a lot higher than what you are able to get in, for example, a money market account. Multiple trigger events. In other words, you're not locked in for the full 5 years. The investment might pay out in a year's time from now. And from a diversification point of view, it gives you the option to diversify by taking some exposure on global multinational companies that are listed in Europe. So if you compare that to the top 40, much bigger companies that derive the revenue from across the globe. If we have a look at page 5, it's a JSE inward listed instrument. So in other words, you would have to own a stockbroking account to buy this share. And the minimum investment is for 100,000 Rand and in increments of 1,000 Rand thereafter. Daily pricing is provided and there is daily liquidity. So if you would like to sell, you can sell at any time. And if there's no willing buyer, Investec will buy it from you, and they charge a 1% bid offer spread, which can be seen as a brokerage, as like any other listed share that you sell. So even though there is liquidity, I would recommend that you only consider investing money in this product that you do not require over the next 5 years, seeing that the maximum duration of the investment can be 5 years. So if we just have a look at some examples here, if this is the initial index level, and if we just look at the first example, in 1 year's time, it's up, in other words, above the initial index. It pays the return, and if we just use the Rand one as an example, it pays you your 20%, and the investment comes to an end. If we have a look at the next example, after 1 year the Eurostoxx 50 is down, and after year 2 it's still down, but at the end of year 3 it's up. It will pay you your initial capital plus 60% return on your capital, as it will be 20% for year 1, 20% for year 2, and 20% in year 3. If we look at the next example, it breaches the barrier level, which is the minus 40. It then recovers. It's sort of between year 3 and 4 goes into positive territory, but on the annual anniversary date, it is below the initial index again, and then it ends on year 5 below the initial index level. Then your capital will be returned to you. And the last example is it falls below the barrier, it recovers below the barrier, recovers again, but it ends below the barrier, which means that you will take a capital loss of whatever that percentage is. So we'll go into a little bit more detail on that. Just remember, whenever you invest in equity markets without any downside protection, this is your status quo in any event. One cannot time equity markets, and if you invest in equity markets with funds that you do not require for the next 7+ years, chances of this scenario playing out is highly unlikely, as equity markets usually recover after big losses, within a 3 to 5 year period of the actual loss. So we'll go a bit into the stats and have a look at the history in this regard. So if we have a look at the Rand autocall based on an investment of 100,000 Rand, here's your call dates 1, 2, 3, 4, and 5, years 1 to 5, and it basically simply states that is the index equal or greater to the initial level? Yes. Then the return is paid out and the investment comes to an end. In other words, you get your 100% of what you've put in plus your 20% enhanced return. If the answer to this question is no, then it rolls for another year. If at year 2 it is positive, then it's called and the return is paid out, and so it goes on up until year 5. There's basically 3 scenarios. If it's positive in year 3, it pays out. If it hasn't breached the barrier, you get your capital back, and if it breached the barrier, then obviously you get whatever the index is worth at that point in time. To explain the dollar one, I'm going to use an example. I just think it's a little bit easier. So if you put in 100,000 Rand, and at current exchange rate, I see the Rand is trading at 14.76 currently, but in the material they've used 15, so I'm going to stick to the 15. Your 100,000 Rand gets converted to dollars, so 100,000 divided by 15 is 6,666.67 US dollars. So if the index is up, you will get 11.25% in dollars, which equates to $750. So if you add the 750 to the initial capital, it means that you will have 7,416 US dollars, which will then get converted back to rands at whatever the exchange rate is going to be in 1, 2, 3, 4, or 5 years time from now, depending on when the actual autocall comes to an end. So we've just used 1 year's as an example here. So let's say at the end of year 1 it's positive. It means that will pay out to you. And they've used 2 examples in the marketing material. If the Rand depreciates by 20%, in other words from 15 to 18 Rand, it will get converted back at 18, which basically means that your return in Rands will be 133,500 Rand. And you have put in 100, in other words, your return was 33.5%. The flip side to this is, if over this 1 year period the Rand appreciates by 20% from 15 to 12 Rand, you still have the same amount of dollars, but now you will be seeing that you will be paid in Rands. It's the 7,416 times 12 gives you 89,000 Rand, which results in 11% loss. So I won't recommend that you invest in the dollar one if you are going to count in Rands. So whenever you invest in hard currency, you must measure in hard currency. In other words, you must have a look at what is the inflation in dollars, and you must subtract the inflation from the yield that you can get in dollars to have a look at what is your real return in dollars. Just an example on the Rand one, you've put in 100, your coupon is 20, it's 20,000, so your return after 1 year will be 120,000. Just if you note the difference between these two, this one allows you to benefit from any Rand depreciation. So the maximum that you can, well, not the maximum, if it depreciates 20%, you can make 133,000 Rand on this investment compared to 120,000 on this one. But with this Rand one, if the currency moves against you and appreciates, you eliminate this scenario where whatever you've gained in dollars gets wiped out by currency movement. And for that reason, I'm going to propose that you consider the Rand autocall at this point in time. I did a bit of homework on the Rand, and I've used the June 1990 as the starting point, which is in line with PSG's house view to determine whether the Rand is under or overvalued. And what I've done is I've also taken January and September as 2 other dates. Reason being that those were the dates where the Rand or the months in which the Rand blew out. In 2002 it went to 1161 in January, and then in 2016 it went to 1659 also in the month of January, and in September of last year it went to 1554. So if we just have a look at the last couple of years here, let's just have a look and say, so in the last quarter of 2015 it was trading at 13 Rand 63, and then it jumped considerably with Nene Gate, as you would recall, to 1659. But then it gradually recovered again towards the end of the year, 1439, even a 1349, 1306, 1296. And then towards the end of last year it blew out again from a 1266 all the way to a 1554. And the same thing happened this year. It recovered, and 1530 was it in September. I haven't changed that to the 1470, what it's currently trading at. But the average for this year is thus sitting at about 14 Rand 53. Now, if you have a look at the average, had you taken money out over the last 29 years every year, you would note that in 1990 your average would have been 2 Rand 59, and over the last 29 years you would have had an average of 7 Rand 60. Now, if we compare that to had you taken money out over the last 20 years, the last 15 years, 10 years, all the way to the last 1 year, you will note that your average would have been 9 Rand 30, 9 Rand 72, just under 11 Rand, 12 Rand 25, 13.84. So you can see there's a trend here. It is gradually increasing, but if you have a look over here, it actually came down by 1%. It went up by 2% relative to had you taken money out over the last 5 years. So at current levels, I won't take a bet that the Rand is going to depreciate from here. I think over time it will appreciate, and as we've seen here, it will get a little bit stronger again. And for that reason, if I was a betting man, I would rather bet on the Rand appreciating over the next couple of years as opposed to depreciating over the next couple of years. Long term, it will, however, depreciate. So it's always purchasing power parity between countries. And as you can see here, if you take a 29-year view, it's at 760 versus 14. So long term it will depreciate, but in the short term I think the Rand is currently undervalued. If we go back to the marketing material, so I've basically covered that example. They just give you the sector exposures of the S&P 500, of the Euro stocks. So you can see here consumer discretionary, consumer staples, and financials being the dominant sectors of the Euro stocks. Like I mentioned, just keep in mind that only 35% of the revenue of these companies are actually coming from Europe itself. So 65% of the revenue is generated from across the globe. This is once again the price earnings history. I'm not going to concentrate on the S&P 500. One thing I do still want to mention here is the history on the S&P 500. They've basically calculated that 78% of the time the investment will come to an end in year one, and it will pay you the 11.25%. But if you have a look at the potential loss ratio, in other words, how many times would it have breached the barrier of 30%, it's 0% of the time. And that is due to the fact that the S&P is currently trading a lot higher than the previous highs. So you will see now when we cover the Euro stocks, it's actually currently trading almost at its long-term average, meaning that it is trading at fair value, if I can call it that. So it had two highs in 2000, in March 2000, and in December 2007. So if we have a look at the same analysis now on the Eurostoxx 50, it basically says there's a 70% probability that it will pay you the 20% in year one and come to an end, a 1% probability that it will pay you the 40% in year two, 6% for 60% in year three, 5% that it will only end in year four, a 2% that it will end in year five, a 10% probability that your capital will be returned to you, and a 6% probability that the index will be more than 40% down from current levels. But like I said, this is taking into account these two previous highs. So from current levels going forward, excluding those two highs, I am of the opinion that this figure will also be 0%, just like it is on the S&P 500 one. Due to the fact that those two highs has been factored into this 6% figure. Just from a fees and a procedure to invest point of view, like I mentioned, all fees are built into the product, so no additional fees will be levied during the investment term, and the advisor needs to have these FSCA licenses in order to give advice on these products. Tax implications, you will see that Investec has put a disclaimer in here. I'm not a tax practitioner, but I will give you my view on the tax. You're welcome to double check that with your tax professional. So if we can have a look at that, I've compared it basically to a money market investment, as most of you are currently sitting in cash and you're sitting on the sidelines as you are scared to move into equities due to the fact that the world is an uncertain place at the moment. But as you know, cash has got the worst chance to outperform inflation over the long term. Be that as it may, let's have a look at the figures. So if you're currently sitting in cash, you have 100% downside protection, or I should rather say 99%, as the money market is not 100% safe, but let's call it 99.9%. And your growth is linked to SA interest rates. So if rates come down, your yield will also come down. I've used a figure of 7% per annum. We can chat about this with regards to your personal circumstances. If you get more, or if you get slightly less, I can tweak these figures for you, and I can personalize it for you, but I've just worked on a general figure of 7%. And just for the record, it is anticipated that rates will come down. But currently the status quo at 7%. You will pay income tax on that yield. And I've worked on 45% income tax rate, as most of you are on the maximum tier when it comes to marginal tax rate. So you will pay 3.15% tax, which is the 7% times the 45% is what you'll pay. So your return after tax is going to be 3.85. If we subtract inflation from that, it basically means in real terms you have earned a negative yield, which just basically means that you are not beating inflation. In other words, you are going backwards. And I've said here credit counterparty risk. I've named all the big 5 banks there, seeing that all of you are banking with different institutions, but the rate is more or less the same. Liquidity is daily, and there's no closing date and no trading date. So if we have a look now at this product, I've broken it down into 2 columns. If the product calls in year 1 and year 2, what will be the tax status quo? And if it calls in year 3, 4, or 5, what will be the tax status quo? Reason being, this is a JSE listed share, and the Income Tax Act, Section 9C of the Income Tax Act states that if you own a JSE listed share for 3 years or longer, then capital gains tax applies. But if you sell it before a 3-year period, then income tax applies. So if we look at the first column D, year 1 to 2, it says it provides 100% downside protection at maturity, provided that the index does not end more than the 40% down. I have explained that. Your growth or upside is linked to the Eurostoxx 50, and it just has to be flat or at the current level or positive in order for you to get the 20% per annum. So your nominal return is then 20%, and I've subtracted income tax. In other words, I've taken 45% off the 20%, which is 9%. That will leave you with 11% after tax. So if we subtract the inflation of 4.7, it leaves you with a real return of inflation plus 6.3%. So looking at the current environment, looking at balance funds, looking at low equity funds, 11% after tax return is a very attractive yield. If we have a look at the credit risk or the counterparty risk that one will be taking with this investment, you will take credit risk on the issuer, which is Investec South Africa, and on Standard Chartered Bank, which is one of the biggest banks listed in the UK. Maybe just on that point, I can quickly show you. Here I've just basically put a table together on Standard Chartered, RBS, and the 5 local banks. First Rand being our biggest bank, is more or less the same size as Standard Chartered. And Standard Chartered has slightly better credit ratings, predominantly due to the fact that our local banks' credit ratings cannot be better than what South Africa's sovereign rating is. But nonetheless, I've taken 3 ratings here: Moody's, Fitch, and S&P, and I've just put a table in here to show you how you can interpret these credit ratings. If we look at Standard Chartered over there, their credit ratings is basically A2A and BBB plus, which is very, very good. But most importantly, when it comes to ascertaining, what is the lowest risk versus the highest risk when investing in the capital structure of a bank, it's important to note that this investment sits here in the senior debt tier, which basically means that the risk of loss, the equity or the ordinary shareholders of Standard Chartered is taking the most risk, which basically means that their total market cap of 385 billion Rand has to be written down to 0. Then all the preference shareholders' total share capital must also be written down to 0. Then the subordinated debt holders must write down everything to 0, and only then will the senior debt holders stand a chance of losing any money. So from where I'm sitting, very, very safe investment. The chances of this happening, in my opinion, is very, very low. If we go back to, where was I? Back to the analysis. So that will basically be the risk that you're taking. The minimum investment is 100,000 Rand, and the investment type, it's an inward listed share on the JSE. Like I said, there is weekly liquidity, but I would recommend that you only invest the funds that you do not anticipate you're going to need for the next 5 years in this investment. If we now have a look at the scenario where the investment does not call in year 1 or 2, and it only calls in year 3 to 5, everything here remains exactly the same. The only difference is now capital gains tax will apply. And once again, I've worked on an individual whose marginal income tax rate is 45% times a 40% inclusion rate gives you 18%. So I've taken 18% off the 20%, which leaves you with 16.4%. And if you take inflation off there, it leaves you with a real return of inflation plus 11, which is an absolute phenomenal return. So once again, all the other factors remain exactly the same. So in my opinion, regardless whether it calls in year 1 or 2 or year 3 to 5, the fact that it pays a 20% coupon makes it a very, very attractive investment. It again gives you like a worst case scenario of 11% and a best case scenario of 16.4%, which equates to inflation plus 6.3 and inflation plus 11.7%. If we now have a look at the Eurostoxx 50 just in a little bit more detail, what I've done here basically was to take the top 40, which most of you are more familiar with than the Eurostoxx 50, and I did this as at the 15th of October, and the exchange rate at the time was 16 Rand 30. So I've just taken the market cap in euros and converted it to rands at 16 Rand 30 just to give you a feel for how big these companies are and how does that compare to the top 40. So then I've ranked the shares here from number 1 to 40, and then obviously the last 10 over here, as the Euro stocks have got 50 companies included in there. But what I wanted to point out is, if you have a look at AB InBev, listed on both exchanges, let's just call that the same market cap. So number 1 on our exchange equals to number 2 on the Euro Stoxx 50. But you will see that our second biggest company, being BHP, is the equivalent of Airbus, which is ranking in 9th position on the Euro Stoxx. And then the gap gets quite wide. British American Tobacco, 1.2 billion, 1.2 trillion, apologies, in market cap, equivalent to number 16. Then we move over to Naspers, sitting in 4th position, just over R1 trillion, and that is equal to the 28th spot, being Adidas on the Euro Stoxx. And then Richmond at 631 billion in 5th place, and that is in 46th place, if you compare that to the Euro Stoxx. So you can see here a lot of companies still in the trillions, whereas we only have 4 companies with a market cap in excess of R1 trillion. So these companies, you will recognize some of them: Unilever, Volkswagen, Santander, Bayer, Sanofi, Total, SAP. So very, very big multinational companies that you will be exposed to. And if we have a look at the totals, you will note that the Euro Stoxx is about 4.5 times bigger than what the top 40 is, if we only look at the first 40 companies. But if we look at the top 50 as a whole, it's about 4.7 times bigger than our top 40. So yeah, from a counterparty perspective, I think it's wise to diversify some of your money away from the South African market and taking exposure to some offshore shares. If I just go back to the presentation, the credit risk, I think I've covered that in a bit of detail. And then just important dates is the closing dates and the listing dates. Yeah, this is by no means the full presentation. This is just an appetizer, just to give you an idea of what is available. If you are interested and you would like to discuss it in more detail with me, please do not hesitate to contact me. Have a great day. Cheers.